Dividend stocks can be a powerful tool for investors looking to achieve financial independence. Dividend stocks provide a steady stream of passive income, which can help anyone who chooses to invest in them cover their living expenses and eventually replace the need to work for a paycheck. In this video, we're going to cover the basics of dividend stocks and how you can use them to build a portfolio to help you work towards financial independence.
Dividend stocks are stocks of companies who have decided to pay back a portion of their profits back to their shareholders. Their shareholders are anyone who owns a company's stocks. Now, when it comes to what they're paying back, these dividend companies are paying back to their shareholders is actually dividends. Dividends are scheduled payments that you get from the company just for holding the stock. It is a portion of the company's profits that you're getting back as a shareholder just for holding the company's stock. Now, dividends are a key source of passive income when you want to achieve financial independence, because all that is needed is an investment of your money and none of your time. Now, the first way to use dividend stocks to achieve financial independence is actually to build a diversified portfolio of dividend paying stocks. That way you can spread out your risk and also increase the stability of your income. For example, when I buy shirts, I buy long sleeve shirts, short sleeve shirts, and I might even have a few tank tops. And that's because I want to make sure I am ready for any occasion and also for any type of weather. On top of that, I don't buy my shirts from just one company or one manufacturer, because if that manufacturer went out of business, I'm out of luck. So keep those things in mind when it comes to buying stocks for your portfolio. You want to make sure that you have a multitude of different dividend paying stocks, but you also want to make sure that you don't have all your money invested in one type of company, because if that company went bust, you won't get the dividend payment.
Now, the next way in order to use dividend stocks in order to reach financial independence is to choose stocks that have been paying a steady dividend and have been increasing that dividend over time. When we're reaching financial independence, you're looking for a dependable source of income, and going for companies that have paid a steady dividend and have increased that dividend over time lets you know that's a healthy company. That company knows its operating costs and knows that it could pay some income to its shareholders, and that's a good company for us. If you are able to combine that dividend income with something that's steady also, like rental income, then you're good. Now, buying rental income may be something you want to do down the line, because when you're going for financial independence, there are different levels, and rental income may be something on another level for you, but dividend stocks can help put you on the first level with minimal effort and minimal time. You can do this with a small investment and get on the first level of reaching financial independence just by buying dividend stocks.
Use the dividend payments you get to buy more company stock rather than just taking those cash payments and putting it into your pocket. Doing this will allow you to grow your portfolio over time, because you're actually what is called reinvesting your dividends. When you reinvest your dividends, you're actually using those payments to buy more shares of that company. And this will allow your portfolio to grow over time. Now, truthfully, make it easy on yourself and just start reinvesting your dividends as soon as you buy the company stock, so you don't have to worry about it in the future. When you do this, you allow the power of compound interest to start working for you as soon as possible. Now, if you don't know, compound interest is when you make money not only on your initial investment, but also making money on the interest that your investment made for you as well. For example, let's say you invested $100 and you get a 10% rate of return on your money. At the end of the year, you will have $110 because you've made $10 in interest on your investment. Now, if you decide to leave the $10 in the market along with your 100 rather than taking it out, if the market returns another 10%, you will actually have made $11 the next year in interest. That extra dollar was made because it made money on your interest. It might not seem like a lot, but as you accumulate interest and you let that interest compound, the effect that it will have on your investment becomes exponential. Here's a crazy fact for you. Warren Buffett was worth $84 billion in 2020. Did you know that $81 billion of that money was actually made from compound interest? That is crazy.
Use your dividend income to cover part or all of your living expenses. Eventually, your dividend income will replace the need for you to work for a paycheck. Now, there's different levels to financial independence, so you have to be patient. And the longer you can hold off actually taking your dividend income out and using it for your living expenses, the better it will be for you. Like Nicole said before, the longer you can keep your money in the market, it has the ability to compound. When it compounds and you wait later on, you may be able to just live off of your dividend income payments or the interest of your investments. Or you can choose something like the 4% rule and withdraw based on that amount off of your investments and leave the principal in the market continue to grow and pay you income over a longer period of time. Believe me, being patient is the best thing for you because the payoff is worth it when you reach financial independence. The longer you can hold off taking that money in form of cash payments and leaving it in the market, the better for you. If you don't know what the 4% rule is, leave a comment below and we'll probably make a video about that in the future.
Monitor your portfolio on a regular basis and make changes as needed. Now, the only thing we know for investing for sure is that the market fluctuates. That means the market goes up and it goes down. And when the market goes up and down, some of your investments will also go up and some of them will go down. Because of this fact, you have to make sure that you are looking at your portfolio and making sure that you're not overexposed or highly weighted in investment more than you actually want. Now, if any of these things that I'm saying sound confusing, don't worry. Click the link below in the description and join our Wealth Pack community. The Wealth Pack community is the community we have outside of YouTube where we share our live trainings, our courses, and all the things that we believe you should know first, and we teach in more detail there. If you're interested in learning more about the Wealth Pack, click the link below and join us. And just like a pack, we promise we don't let anybody get left behind.
Dividend stocks can be a valuable addition to any investment portfolio, especially for investors who are seeking financial independence. If you choose dividend stocks that pay a steady dividend, have increased that dividend, and then you reinvest those dividends to buy more shares of those companies, you can give yourself a reliable stream of passive income. Dividends can help you supercharge your way to financial independence, and it's something you should definitely use if you're trying to reach financial independence in a stable and consistent way. If you enjoyed this video, make sure you subscribe to the channel because we will love to have you part of our community. And catch you in the next video.